Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing. All right, let's get into this week's report. Hooray, we got a rally. Not anything incredible, but it is a little something to be happy about. So let's just start with the recommendations. Got a little bump in the markets. We need to talk about what to do with that. I want to make sure we get that out of the way first. All right, so the first thing we want to do here is we want to just check through these items. Item number one, recommendation number one, sell an additional 20% of quarter one corn bushels. Sell an additional 20% of quarter one bushels. In December, we sold 10%, and then a week or two later, we sold another 10% of our quarter one corn bushels. Now we're going to level that up, sell 20%. We'll be 40% sold on quarter one corn bushels. The way that I like to think of kind of a rhythm of sales, quarter one bushels, we've got 3 months to sell it. If we're 40% sold halfway through January, then we're a little bit ahead. It's nothing too off pace, but if we need to be patient here for a little bit, we've kind of bought that time to be patient on some sales. Next item, I'll check the box there, is we're going to sell 10% of quarter two corn bushels. 10% of quarter two corn bushels. The third item is we are going to sell 10% of new crop corn bushels. 10% of new crop corn bushels. Now let's shift gears to soybeans. Check that box. We're going to exit the remaining long soybean positions that we have. If you remember, with our quarter four bushels, so that it's 35% of the quarter four bushels. What we did was we sold soybeans. It was not a very good sale, but we re-owned those soybeans, 70% of those. And then the markets went down and the markets came up, and we got out of half of that, close to break even, maybe a little bit of a loss, maybe a little bit of a profit. Now we got a rally and we're going to exit the other 35% of those. Depends where you get filled, but that should be a winning trade, right? That should be a re-ownership that works. So we're going to do that. We're also going to be aggressive on selling 50% of our quarter one soybeans. 50% of quarter one soybeans. Basically, we're playing catch up to the rate of sale for corn, but we just now got the bean rally. We're going to play catch up. We're actually going to do 10% more. So we're going to sell 50% of quarter one soybean bushels. Got to check that box there. All right. Now let's get into a little bit of the analysis, and we will go from there. You should be able to see photos. There's a couple of pictures, just a little bit of a rundown on what's driving this market. We'll talk a little bit about the USDA report in a minute, but there's two things. The USDA tightened the global. It just, the fundamentals got a little tighter on last Friday's USDA report. That gave us one bump, and then we came into this week still with dryness. So the pictures I'm showing you, they're from the state of Paraná, and they're definitely, talking to a customer down there, he said, this is Western Paraná. He said, there is definitely yield loss already. He wouldn't take a stab at how much yield loss there is, because will it rain or will it not rain? So if they get rain here kind of soon, it might not be that much of a loss. I would guess maybe take 10-15% off their yield. If they go another week or 10 days without rain, it's pretty serious. Talked to a customer in Paraguay yesterday, and he's expecting nationwide, he's in the real good area, the Iowa, Illinois, so to speak, of Paraguay. And he said average nationwide, he thinks that you're gonna trim 20 to 30% off of the Paraguay crop. Just to put some numbers on it, Paraguay produces about 10 million metric tons. Good year, maybe 11, 12. Bad year like this one, we're probably looking at 8-9 million metric tons. So it's nowhere close to, Argentina's 50 million metric tons ballpark, or Brazil is pegged at 170 million metric tons. So it's not even in the same ballpark, but it still reduces, it's still maybe 2 to 3 million metric tons, which, if you think of how much the last USDA report cut out of global supply and demand, it's only about that much, and we got a bit of a bump, right? What the USDA report did not do on Friday was reduce the crop in South America. So you could see a couple of these pictures of stressed crops. This is from the state of Paraná. And you could see kind of where they are from a developmental standpoint. Now, picture paints 1,000 words, so I wanted to make sure you see the picture of the crop, but I also want to pull up here just give me a second here for me to find this. All right, we wanted to pull up, in a nutshell, what Brazil's crop, where it is developmentally. Again, Brazil is 70 million metric tons, or I think the USDA number is 169. Some private estimates are over 170. Some estimates are below that. That is the monster crop in Brazil. So where is it developmentally? Because that gives us a bit of an idea. And this 54% here is this yellow area. That is filling, enchimento de grãos it's filling the grain, or filling the pods. 17% is flowering. So there is potential yield loss. These are the two categories where I'd say we could have yield loss, right? We could have yield loss, maybe a little more if in the areas where you get the flowering, that cuts potential. But if there's not rain, if there's not rain to fill those pods, there is a significant amount of Brazil's crop that is still vulnerable. I think I mentioned last week or 2 weeks ago, beans in the U.S. are made in August. Well, January is similar to their August. We'll shut that down and start, in just a little bit, we'll talk about other markets. I don't think this is a really significant story out of South America, because the northern production regions are looking very, very good. So maybe you're going to trim 5-10 million metric tons off of the crop in southern Brazil, but you might pick up 5-10 million metric tons out of good yields, bumper yields in the northern part of the country. So from a global supply and demand standpoint, I think the Brazilian crop should come down a little bit. I think 170 is high, but maybe 168 or 165. I think it should come down a little bit, but it's still a monster crop, right? It's still a lot of soybeans. As far as when will harvest start? Well, those early soybeans will start being harvested yet this month. Have some customers that are going to start running maybe next week. By the end of January, a lot of them will be already starting to harvest soybeans. Again, that's those early soybeans that they can turn around and plant double crop corn. So February is probably the busiest month of the year in the field for farmers who do double crop corn and soybeans. In February, they are, full speed ahead with soybean harvest and full speed ahead with double crop corn harvest. But they'll get started on that maybe next week for sure. By the end of January, the farmers that do double crop corn, it's going to start getting real busy real quick. All right, enough about South America. Let's look at markets and let's look at the rationale behind it. I always like to throw up the pyramid because this describes the philosophy of how we handle markets. Baseline, build a portfolio custom to your operation. And then within that portfolio, you get specific recommendations. And then how are these recommendations constructed? Seasonals, the net position of the funds, technical analysis. That's the middle level of the pyramid. That's what we're going to get into in just a minute. And then the top point is action. You need to execute. So for me, that's the right way to construct a marketing strategy. And you don't need a crystal ball. You don't need to know the future or to expect perfection. But if you build it in that way, you will make progressively good decisions throughout the year and throughout the years, and those progressively good decisions compound results. Again, that's the philosophy we handle markets. If you've been with us a long time, you might be tired of seeing that pyramid, but for me, that's just ingrained in the way that I think about markets so much, and I really want people following along to have that same thought process. And it does a tremendous amount to align expectations. It does a tremendous amount to reduce the uncertainty and the emotional stress. If we say, I build a portfolio, I'm managing this portfolio, I want this portfolio to perform well. All right, so let's get into the nitty gritty here of the analysis section of the video. All right, here we go. The first thing I want to do, and let me grab a color here. I think maybe blue will work. Blue will work nicely on this. All right. Why would we be aggressive at this point? If you're thinking that selling 50% of quarter one soybeans is aggressive, why would we be aggressive at this point? That's because we are at the smallest. I included January, I included the 2025, this first COT report, the first position of the funds report. I included the January 25 and the 24 chart because we really wanted that reference just to be able to look back on it. But we are at the smallest net sold position of soybeans in Chicago since the first of 2024. And then we also got tail end of May, we got to similar levels there. That is the reason that we would be saying, let's sell this or let's take profits on longs from the standpoint of looking at the funds. Just, okay, this last time they were here, after they got to this point, this was a huge sell-off. This was a huge sell-off. Maybe we should go ahead and get rid of maybe we should go ahead and take advantage of these price levels. From a fund standpoint on soybeans, that's a little bit of the rationale. And then on corn, it's actually a little bit different, and we'll get a little different color here. Let's give green a shot. There we go. On corn, the good news is, again, I included January here, but we are at the highest
highest net long position for corn that we have had since 2023. This isn't those astronomically high overbought corn positions, you need to sell it. It's not that, but they have progressively since first part of November when they got positive, the clear tendency is this stair step up. That is good news. That is exciting news. Speculators want to own corn. Does that mean they're going to get rid of it, or does that mean they're going to keep buying it? I think the main thing that's important to realize is that this has been primarily a speculative buy on corn. Fundamentals got a little tighter, but it's not been a basis-led rally. It's not been a spreads-led rally. It's been a spec fund-led rally. So what to expect now? Okay, spec funds kind of bought it up. That's good news. What to expect now? We're going to work through several of the corn and soybean contracts because I want you to kind of understand the rationale behind the recommendations kind of one by one. So we'll start here. The first recommendation was sell 20% of quarter one corn. So I pulled up the March contract. That's what we would be selling against with quarter one bushels. What's the rationale? And let's get this in black. Boom, there we go, black. The rationale for selling quarter one bushels is basically we are at the highest price level. You know, if you look at that, we're at the highest price level. We're in the upper fours on March corn. It's been a while since we've been here. I think this $5 mark is something that is very, very desirable. This would be the classic case, in my opinion, where we would see somewhere in here, maybe yesterday, Tuesday's trade was the high tick, or maybe we can, get some friendly trade, come up to 490 or something like that. But somewhere in here, I think selling pressure will limit our gains. And I think it will be hard for us to continue rallying short term. The huge question in my mind is, regardless of how high we go, this will probably come down to catch its breath. Well, does it stop at the 20-day? That would be good news. Or does it, if this 200-day kind of turns a curve, does it come down to the 200-day? Or does it completely lose steam and, trade down here to some support? That third alternative, I don't really expect for a few reasons. I think we will probably have a somewhat supported corn market, and that's why we're not more aggressive on other sales. If you look from the lows back in here, and even really in here, this very much looks just kind of like a stair-step market up, right? So it comes down, and then it comes up again, and then it goes up again, and then it comes up again. So I think probably we're going to keep stair-stepping up. I think that's the more likely thing. And this isn't something like, wow, Aaron had a great idea. No, we usually stair-step up in the corn market between harvest and some weather uncertainty in the spring. That's the usual thing to happen. So as we need to move corn throughout the year, got a little bump, sell a little bit, comes back down, got to get another bump, sell a little bit. That's not a bad move. I do like the idea of getting enough sold to where if we need to be patient sellers for a little bit, we'll be okay. The next chart that I want to show is July 2025. And the thought process here, this would be for our, sell 10% of quarter two bushels, if you think about that recommendation. The main thing is just to reward a rally. I hope that on your quarter four bushels, I hope this market keeps stair-stepping up. And I hope that this is kind of the worst sale that you make on your quarter two. I'm sorry if I said quarter four. On our July 2025, we're talking about quarter two bushels. I hope that this is a sale that brings your average down on quarter two. But when you get a rally with everything that we've been through, we have to remember that the fundamentals, it's not like they got super tight. we still have quite a bit of corn in the U.S. With the ratio between corn and soybeans, probably, I mean, the battle for acres is probably leaning towards more corn acres. We'll keep an eye on that, but as of right now, that's what it's looking like. It just makes sense. Highest prices since June of last year. Largest overbought, speculative corn position since 2023. That's a rally, whether we like the price very much or whether we like the situation very much. That's a rally we just make sure we're participating in, and we're putting that in our pocket. And that goes same basic rationale, but I'll pull up, here's the December. The December actually is maybe even a little bit stronger case, because let me just point out a few resistance points. Every time we've gotten right around this price level, we don't know what'll happen this time, but every time we got here in the past, that was a pretty significant resistance level. That coincides with the 200-day moving average coming down. That up against this resistance after the bad markets that we've had, if 450 is the lowest average price for a corn sale, nobody's going to be too excited about it. But again, I feel like you should be swinging at it, just layering into an average with 10%, nothing aggressive. Hopefully we get chances at $5 hedges sometime in the spring, and hopefully that's the case. But it's just 10%, right? You're just getting a stake in the ground, starting to get a benchmark for averages this year at the price that has found resistance in the past on that new crop. We don't need to overthink it much more than that. It's just kind of taking it one step at a time. All right. Shifting gears now to soybeans. This is the March 25 soybeans. If you'll notice the difference on the recommendation, so soybeans is just two things that we're pointing out. The first one, and I'll talk about that when I show the July contract, is sold Q4 beans, had some re-ownership, were higher. We're going to get out of that re-ownership. That's the first thing. I'll talk about that when we do the July. The next thing is, we still need to remember that about half of Brazil's crop that's going to be harvested, like I said, beginning next week, is unsold. I find it very difficult to think that soybeans are going to have just a runaway rally to the upside if we've got anywhere from 80 to 100 million metric tons, probably not 100, but we're probably at about 80 million metric tons of soybeans that will need to trade hands, maybe a little bit in January, but say February, March, April, we likely are going to have about 80 million metric tons of soybeans out of Brazil, adding selling pressure on top of that. Spec funds haven't even bought soybeans yet. They're kind of a little uncomfortable with being sold, and we've got a ton of selling pressure out of South America. So I think that this Q1 might be a very tricky time for the soybean market. So, okay, well, Aaron is, bullish corn, but he's bearish beans, but he says that ratio needs to improve. This, this doesn't make this make sense. The truth of the matter is, we're just making decisions 1 week at a time, and that's the best we can do. For this week, I think it makes sense to take quite a bit of risk off the table on your Q1 soybean sales, and that's it. That's the extent of it. Once we get into planting and battle for acres news and all that news that comes March, April, May, that's an eternity away. We don't know. By then Trump will be in the White House. Soybean harvest will be over in Brazil. We're going to be talking about corn risk. We're going to be talking about battle for acres. There are a lot of headlines that will come and go in the next few weeks and months. But for today, we're going to take a lot of the Q1 risk off the table by making sales at a price point that we've struggled to spend very much time above for really since like July of last year. And then we're shifting to the the last chart here talking about recommendations. July, if we just kind of go back, what happened on our Q4 bushels? Well, about in here, sales were made and reownership took place. About in here, part of that reownership was exited, and then here we're going to exit the rest of that that reownership on the Q4 soybeans. All right, so now we will go over, we have a few questions, and then, well, let me do this first. Let me go over the, just kind of a rundown on the analysis and the thought process behind it. There we go, we got the screen. So seasonally, it is neutral for corn. It's neither a buy nor a sell. For soybeans, because of the weather risk in South America, it is a sell. Managed money, corn is bought. They are long, but they are not bought long enough to sell. And soybeans, spec funds are sold, but not a big enough sold position to justify anything. And both corn and soybeans are in uptrends. I like to sell in uptrends. Basis has softened as Chicago has rallied. That's the first thing. The next comment I'm going to make on basis, here we go. Basis tends to move sideways during the winter months. You might be able to pick up a nickel here or a nickel there, maybe a dime, but basis is there aren't significant basis opportunities typically at this time of year. Technical considerations. I'm not going to summarize the technical considerations in this video because we went chart by chart, because you'll see, like new crop corn is at resistance levels. The story is a little bit different across contracts, and we just went through those in detail. So I'm not going to go through those right now. Before we wrap up, let me just answer a few questions that we have and go from there. All right, so number one, do I hedge using futures or options? That's a great question. It's not a one-size-fits-all question, obviously, but I would tell you on this week's recommendations, the only position that isn't just a simple cash sale is stepping out of longs on soybeans, that for my recommendation, right? And when we got into those, I had suggested futures, so that's that. In these recommendations, I make the recommendations kind of assuming it's futures. That's my default. I realize that that's not for everyone. Some people like options, and that's fine. This is the way that I see futures and options, right? And again, I'm not going to impose my risk vision on you. That's particular to each one. But if I buy futures, basically in a nutshell, I need to get the direction right, which is challenging enough. If you deal with options, you need to get the direction right, the timing right, because they depreciate, and you need, well, if you're buying options, I should say, timing right, the direction right, and you need to get the magnitude right for your strike price. So there is a lot more that you kind of need to get right in order for options to work. That doesn't mean that it's not the right tool. And for some people, it absolutely is the right tool and the right approach. From the standpoint of recommendations in this video, my default is to go over just assuming kind of it's a futures position, and then we can manage the basis separately. But what I'm aiming at is whenever there's basis opportunities rather than futures opportunities, or whenever we need to move inventory, but we don't really want to accept the price level. So the futures is just the best exchange for that cash position and kind of the most direct way. So that's my default is kind of to use futures. Now I realize that that's not for everyone. I realize that that's something you need to sort out, but that's my thought process. Next question: should I sell cash or HTA? There are times in the year where there are fairly significant basis opportunities and basis strategies, and when that is the case, I will make those recommendations from a basis or HTA standpoint. Is it possible that you could maybe improve your results using HTAs instead of just moving the grain? It's possible. Or probably, I would be surprised if it's much more than a nickel. Basis is typically sideways, right? So the way that I see it is, let's say that you have 1/4 bushels, right? And you're saying, should I do an HTA or should I do a basis? But I'm going to move my grain in the winter. Your biggest opportunity is probably to not move the grain in the winter and to move the grain in sometime in the spring or summer when it's the dearest. And then basis can absolutely be a factor that plays in, and HTAs can absolutely be a factor that plays into your marketing. But historically speaking, this is kind of a sideways, boring time for basis, or at best, a slow, gradual appreciation of basis. So if basis is doing this, even if it's going up, can you do an HTA and get one of these tiny little moves? Yeah, maybe, but most of the action will be in Chicago, right? So, Chicago went up 20 points, or went up 20 cents, and basis came down a nickel or 3-4 cents, right? The cash sale is the big decision. Get that right, and then there aren't typically significant basis opportunities right now in the winter, and for that reason, just keep it simple and just be done with it is my thought. That doesn't mean it's wrong. That doesn't mean it's wrong to necessarily do HTAs, but there's not enough of a systematic strategy to where that's going to be year in and year out the best alternative for you. To where I would change your recommendation at this point in time. Will the U.S. exports stay strong with harvest in Brazil starting? That is a great question. I would say there is the assumption, right? As soon as Trump, this is probably 6 months ago, as soon as it was pretty evident Trump would be in the White House, there was kind of this assumption that what would happen back in 2018 would happen again, which is the price of soybeans struggled and corn also, but soybeans got punched in the gut back in 2018. Basis in Brazil skyrocketed. Brazil got all the export business. That's what happened back then. And the assumption was that's going to happen again. And maybe it is, right? I'm not making any type of geopolitical comment, but there is a very important observation to make. And the observation is China and other foreign buyers, as when harvest was over in the US, their attitude wasn't like, well, there's plenty of grain in the world, I'll wait for Brazil. Their attitude was, let's stockpile. And China accumulated, I think it's their largest soybean inventory, I think, on the books. But regardless of whether it gets the gold medal or not, China bought a ton of soybeans from the US also, right? So the behavior of China as the biggest buyer, but other countries, it seems more like, let me make sure I have enough instead of, I'll wait and buy it cheaper later. So let me make sure I have enough, this stockpiling behavior that to some extent changes our previous ideas on how much is enough. Because it's not, let me make sure I have enough compared to my historic needs. Let me make sure I have enough, let me make sure I'm buying it cheap. It's let me make sure I have enough for what? This type of buildup in grain reserves is typical when there is geopolitical uncertainty. And so I'm not making any type of commentary. I'm just looking into export data. That's it. All right. So will the U.S. exports dwindle? Maybe, or maybe there is enough uncertainty geopolitically to where they say, yeah, I want all the grain I can get out of the U.S. and I want all the grain I can get out of Brazil. I need to buy enough grain for me to feel safe. And if that's the mode, we have no clue how big that number is. So a lot of people are real quick to write off that as soon as the South American crop comes in, we're going to lose demand. And I do think that'll be probably the predominant headline, but I'll just put it this way. That's the overarching narrative. That's probably going to be the predominant headline, is that we lose business to South America. I'm definitely going to be week by week reading fine print to see if buyer behavior is changing, because what their actions, they say actions speak louder than words. What actions are saying, maybe the words are saying I'll buy from Brazil later. Actions are saying let me stockpile grain. So for me, I don't want to overstate that. I don't want this to change the way you market your grain, make your decisions, see the world. But this is the type of headline that I think you should just be zeroed into, that, okay, what would typically happen is Brazil gets all the export business, we go way down. That will probably happen to some extent. But the behavior of the Q4 exports was more like stockpiling than it was, let me just buy a minimum to make it to the Brazil harvest. So let's see if that changes. A lot to go over this week. So much nicer to put out one of these videos when we have a rally. Thank you for watching, and send me any questions you have.